Introduction to Financial Services, Insurance. Updated January 4, 2021. This in focus provides a summary of the insurance market and regulatory system in the United States. Market structure. Insurance companies constitute a major segment of the U.S. financial services industry. The insurance industry is often separated into two parts: life and health insurance, life health, which also includes annuity products, and property and casualty insurance, property casualty, which includes most other lines of insurance, such as homeowners insurance, automobile insurance, and various commercial lines of insurance purchased by businesses. According to the insurance rating agency AM Best, 2019 net premiums for the more than 300 life health companies with over 800 subsidiaries in the United States totaled $645.2 billion, with admitted assets totaling $7.07 trillion. The 2019 net premiums for the more than 1,000 property casualty insurance companies with over 2,800 subsidiaries totaled $637.1 billion, with admitted assets totaling $2.2 trillion. Despite the large numbers of insurance companies, both life, health, and property casualty insurances are also reasonably concentrated industries, with the top 25 life health company groups writing 60% of overall premiums and the top 25 property casualty company groups writing 69% of overall premiums. Figure 1 displays the market share of the top 25 insurers versus the rest of the market in 2017. Figure 1. Insurance market concentration. Net premiums. Dollar billions. Different lines of insurance present different characteristics and risks. Life insurance typically is a longer-term proposition with contracts stretching over decades and insurance risks that are relatively well defined in actuarial tables. Annuity products, which are also usually offered by life insurers, present similar long-term insurance risks. Particular life insurance and annuity products, however, may be based on securities, such as stocks or bonds, and thus may present shorter-term risks more similar to investment products for both the consumer and the insurer. Property casualty insurance typically is a shorter-term proposition with 6-month or 1-year contracts and greater exposure to catastrophic risks. Health insurance has evolved in a different direction than life and property casualty insurance. Many health insurance companies are heavily involved with health care delivery, including negotiating contracts with physicians and hospitals, rather than purely insurance operations. The health insurance regulatory system is much more influenced by the federal government through Medicare, Medicaid, the Employee Retirement Income Security Act, ERISA, PL 93-406, and the Patient Protection and Affordable Care Act, ACA, PL 111-148, than life and property casualty insurance. The following discussion focuses on property casualty and life insurance. Role of federal and state governments. The role of the federal government in regulating private insurance is relatively limited compared with its role in banking and securities. Insurance companies, unlike banks and securities firms, have been chartered and regulated solely by the states for the past 150 years. There are no federal regulators of insurance akin to those for securities or banks, such as the Securities and Exchange Commission (SEC) or the Office of the Comptroller of the Currency (OCC), respectively. Each state government has a department or other entity charged with licensing and regulating insurance companies and those individuals and companies selling insurance products. States regulate the solvency of the companies and the content of insurance products as well as the market conduct of companies. Although each state sets its own laws and regulations for insurance, the National Association of Insurance Commissioners (NAIC) acts as a coordinating body that sets national standards through model laws and regulations. Models adopted by the NAIC must be enacted by the states before having legal effect, which can be a lengthy and uncertain process. The states have also developed a system of guarantee funds, designed to protect policyholders in the event of insurer insolvency. The limited federal role stems from both Supreme Court decisions and congressional action. In the 1868 case Paul v. Virginia, the court found that insurance was not considered interstate commerce and thus not subject to federal regulation. This decision was effectively reversed in the court's 1944 decision, U.S. v. Southeastern Underwriters Association. In 1945, Congress passed the McCarran-Ferguson Act, 15 U.S.C. Sections 1011 et seq. Specifically preserving the state's authority to regulate and tax insurance and granting a federal antitrust exemption to the insurance industry for the business of insurance. The Dodd-Frank Wall Street Reform and Consumer Protection Act Dodd-Frank PL 111-203 in 2010 significantly altered the overall U.S. financial regulatory structure, but it largely left the state-centered insurance regulatory structure intact. The Act did affect insurance regulation in several areas. 1. Enhanced systemic risk regulatory authority, including authority over insurers, was vested in the Federal Reserve and in the new Financial Stability Oversight Council, FSOC. 2. Oversight of bank and thrift holding companies, including companies with insurance subsidiaries, was consolidated in the Federal Reserve with new capital requirements added. And 3. A new Federal Insurance Office, FIO, was created within the Treasury Department. The Dodd-Frank Act also included measures affecting the state's oversight of surplus lines insurance and reinsurance. Policy issues. Recent congressional attention to insurance regulatory issues can be broken into a number of broad areas. Pandemic response. As public health measures, such as widespread lockdowns, were implemented addressing the coronavirus disease 2019 COVID-19 pandemic, many businesses faced denials of business interruption insurance claims. Such denials typically resulted from clauses requiring physical damage for a claim or from language specifically excluding virus-related claims. While litigation on current claims is ongoing, legislation was introduced in the 116th Congress that would have directly addressed insurance during the current pandemic, H.R. 7412, and created a longer-lasting program addressing pandemic insurance going forward, H.R. 7011. Targeted federal legislation changing the state regulatory system. The 50-state system of insurance regulation has been criticized on a variety of grounds, including for inefficiency due to perceived duplicative and burdensome regulation between states and for ineffectiveness in ensuring non-discriminatory outcomes for insurance consumers. Such criticism has resulted in past proposals ranging from a full federal chartering system for insurers to narrower targeted efforts to alter the state system. Examples of such proposed legislation from the 116th Congress included 1. Expansion of the Federal Liability Risk Retention Act, which preempts state insurance company licensure laws for a small subset of insurance companies, H.R. 4523, and 2. Limited federal regulation of auto insurance rating factors, H.R. 156, H.R. 3693, and S. 4755. The treatment of insurers under Dodd-Frank's systemic risk regime. Under the Act's provisions, the FSOC designated 3 of the largest insurers for enhanced regulation by the Federal Reserve, known as Systemically Important Financial Institutions or SIFIs, between 2013 and 2014. Since the initial designations, 1 insurer's designation was rescinded by a court decision and 2 were rescinded by FSOC. At this time, no insurer is designated for enhanced regulation. In the 116th Congress, H.R. 2479 and S. 1298 would have added a voting state insurance regulator representative to FSOC. Federal Reserve capital standards and insurers. Banking and insurance present different risk profiles, and it is generally accepted that they require different capital standards. In October 2019, the Federal Reserve put forth proposed rulemaking outlining possible capital standards for insurers, but no such standards have been finalized. In the 116th Congress, S. 3123 would have directed the Federal Reserve to tailor its insurance capital standards and give additional deference to the state insurance regulators. The role of the Federal Insurance Office and the Federal Reserve. Dodd-Frank gave the FIO a number of roles both domestically and internationally. Exactly how the mandates are applied and how the FIO interacts with existing actors, such as the NAIC, the International Association of Insurance Supervisors, IAIS, and the United States Trade Representative, USTR, is not clear from the statute. Dodd-Frank also gave the Federal Reserve a role in overseeing many more insurers than it had in the past. Some frictions have been reported in this new system, particularly between state regulators and federal actors in the international arena. In the 116th Congress, H.R. 1862 and S. 1586 would have abolished FIO. Response to international developments. In 2017, the United States and the European Union (EU) concluded a covered agreement particularly addressing issues around U.S. collateral requirements for non-U.S. insurers and EU supervisory requirements for non-EU insurers under the EU Solvency II Regulatory Modernization Program. This agreement provoked opposition by the states and some portion of the insurance industry but entered into force in 2018. On a separate but somewhat interrelated track, the IAIS has been developing new supervisory and capital standards for insurers, which some fear could disadvantage the U.S. system. PL 115-174 directed federal negotiators to achieve consensus with the states in international standard-setting negotiations. CRS Resources. CRS Insight IN 11511, Insurance and Unexpected Risks, COVID-19 in 2020 and Terrorism in 2001. CRS Insight IN 11295, Business Interruption Insurance and COVID-19. CRS Insight IN 11383, Business Interruption Insurance and COVID-19, Federal Legislative Initiatives. CRS Report R 45508, Selected International Insurance Issues in the 116th Congress. CRS Report R 41372 The Dodd-Frank Wall Street Reform and Consumer Protection Act, Insurance Provisions. CRS Report RL 30 2237, Health Insurance, a Primer. Baird Webble, Acting Section Research Manager.